Okay, here we go regarding whether or not you should pay points versus no points and should you refinance. Now, this is a scenario for a client that we put together. It was the most simplistic formula since the loan amount was right at 500,000. We just kept it here to make everything simple or keep everything simple. The difference between a low cost loan only costing them $2,000 versus a 1 point loan with all the closing costs involved, interest, insurance, and everything was $8,450 or $170 a month. Okay, so well, actually this is a loan with points. One-point loan would actually cost $117 a month. Actually, the savings was $117 a month, but the total cost would be a difference of $6,450. So it's $2,000 in closing costs here, $8,450, which meant that there would be a break-even point of 55 months. So you need to, as opposed to just saying, hey, I want a low-cost loan or no-cost loan, you need to figure out when your break-even point is going to be. In most cases, the difference between a loan with points and without points is about 3 to 4 years. Okay, and sometimes as low as 2. It depends on the day, depends on the loan amount, depends on the rate, and the difference in the payment. But you must crunch these numbers because if you came in and said, okay, we just want a no closing cost loan, and rates being as low as they were, obviously they're a lot lower now. But no one has a crystal ball. We don't know what the future is going to hold, and if you think the rates are going to go lower, then the no-cost loan, low-cost loan would probably make sense because it's not costing you anything or it's costing you very little. So if you're saving $500 a month from what you're currently paying, you're going to make this up in 4 months on a low-cost loan. But in making the decision, if you're saving money, go ahead and make the decision, go low cost. But if you're making the decision on your new loan, points versus no points, you got to figure out, okay, what's going to be our break-even point? Chances are the rates aren't going to get much lower than they are right now. Things could change in less than an hour. So if you think you're going to stay in the house or keep the loan for more than 55 months or more than 4.5 to 5 years, then this loan makes sense. If you're going to be there for less than 5 years or 4 years or only 2 years, then one of your low cost options makes sense, but you must know the numbers. You can't just you can do whatever you want, but of course you need to know what this is really costing you, because if you don't, you're looking at a total difference here of about $3,000 over time, which may not seem like a lot of money, but that's $3,000 that can go towards paying off debt, funding a college, starting a college fund, or anything. $3,000 is $3,000. That's a vacation. So a small vacation. So in any event, know your numbers. Make sure you know exactly what each option is going to cost you and make the decision accordingly. Don't just walk in blindly accepting anything and everything that a loan officer or your brother-in-law or your coworker told you. Know your numbers for your specific situation and then make the choice accordingly.